Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
Colin, thanks for joining the podcast.
Ed, it's a pleasure to be on. I know we've been trying to get this on the calendar for a while, so I'm glad we were able to finally do it kind of midsummer here.
Yeah, third time's the charm. And what a day, as we just started talking about today was the CrowdStrike day, and Microsoft, I don't know whose fault it was that took down global IT systems, but I almost didn't make it here on my airline.
It's been quite the day. We've had, obviously I'm not going to call it any custodians, but there's been some custodial difficulties with trading. But other than that, from a business standpoint, we've been unaffected, which is nice. I know there's others that have, their Microsoft has been down or whatever, but for whatever reason, it didn't affect our network. I don't have a full understanding of how the global impacts trickle down, but all in all, we've been unaffected.
What's amazing to me though about that is not about you all necessarily that you're unaffected. Us too are largely unaffected, I believe. But is that how many entities and systems were affected and how dependent everything seems to be on whatever it was, CrowdStrike.
I think that there's no doubt that there's a trickle down effect on this, that it feels like there's a vulnerability that I don't know a lot of this fully understood. And so I'm guessing that there's going to be wide reaching reviews, the causes of this, and ultimately, how do you mitigate this going forward, right? It's like kind of securities and controls. I think everyone's going to be revisiting this more broadly.
Yeah, absolutely. I'm speaking with Colin Falls. He is CEO of GeoWealth. And I'm really excited about this because GeoWealth is, I'd say, one of the largest TAMPs, turnkey asset management platforms that's out there. Help me out with this, Colin. I think from a recent press release, manage over $28 billion across more than 180,000 accounts. Maybe those numbers have changed a little bit. I think I'm in the right ballpark. Yeah.
Right ballpark. When we think about the business, we have roughly $30 billion on the platform today. It's advisors that are using our platform to operate their business. So more broadly, that's platform assets. And then inside of that, we have our own, model portfolio business, which is when we act as a sub-advisor. And so that would be assets under management. And that's kind of in the, roughly 40 to 50% of the assets on the platform are in model portfolios. And so that's the scope of the business. It's across, where I think we're approaching a couple 100,000 accounts, almost 200 RIAs. And so, we feel good about the scale. As you look across the ecosystem, certainly there's the larger software providers and TAMPs. And then there's been, tremendous consolidation over the last 10 years, but really even the last 5. And so as you kind of look out at the ecosystem, I think that it's becoming more defined where the different software providers and firms fit, whether it's in the broker-dealer channel or the RIA channel. And I think consolidation has generally been good for advisors to understand, who the players are for really their different, unique circumstances and needs. I think generally the TAMP marketplace or ecosystem has been a little bit convoluted in terms of the understanding of exactly what a TAMP is. And so I think that as some of the subscale TAMPs have been consolidated, there's a little bit more clarity just more broadly for advisors and the industry to understand.
Yeah. And we've talked a lot about this here on the podcast and internally too, the importance of models, if you will. That's kind of just how I'll put it under that umbrella and TAMPs, of course. And you've alluded to M&A and the growth of the business. To what do you attribute this? To me, it seems like relatively new attention and new dynamic. Is it the growth of the ETF or is it technology?
Yeah, I think it's a little bit of both. I think we've been beating the drum on model portfolios since our existence, so really over a decade. And if you really kind of step back and think about how the industry has evolved, primarily TAMPs and model portfolios existed more in the broker-dealer channel when we got started in 2010. And what we saw in the RIA channel is that it was, I don't want to call it the wild, wild west, but it was more definitely open architecture, more customization, and advisory firms were really forced to select their own software technology, operate it, build their own investment programs. And I think there was a desire to not conform to model portfolios in the RIA channel for a long time, because I think they viewed customization on individual client advice as their value prop. And I think what's happened is model portfolios 10 years ago are very different than model portfolios today, right? And so the model space, it used to be very rigid. There's a marketplace or a list of managers. You kind of selected them inside of a construct. And it was for the right reasons, from a compliance standpoint in the broker-dealer channel. relatively limited. And, what we saw in the RIA channel was that advisors wanted more control. They wanted to express their own views. They wanted to be able to scale the solution. They wanted to do it with economics that made sense, which a lot of the, kind of the model providers, TAMPs, the broker-dealer channel was just a different economic model. And so it's taken longer than I think. I don't know if it's taken longer than we expected. I think that you've seen real momentum here in the last kind of 5 years. I think the model portfolio business more broadly is about $4 trillion. I think, BlackRock recently said it's going to go to 10 trillion in the next 5 years. But I think it is newer to the RIA channel, right? And I think the reason, and there's a number of ways that it's happened, right? It's been, done by TAMPs. It's been done by marketplaces where advisors traded. It's been done where, through paper portfolios from asset managers or advisors building their own model. But I think what we're seeing is kind of a convergence of all of it. And if you have the right technology and you give the advisors the level of control they desire for RIAs, they will be more open to using model portfolios and outsourcing. And so I think it's one of those things like the train's left the station, there's tailwinds behind it. And I think that systematically thinking about investment programs in your RIA practice is kind of the new reality. It's the new world.
What's the mix, do you think, between like ETF models and mutual fund models, or are there are there models on your platform that are both a little bit of both?
Yeah. So in our platforms, that's I think more of a comment. If you look at the ecosystem, like you're going to see more mutual fund models in the defined contribution space, right? Wherein, the RIA channel, you're going to see more ETFs, you're going to have fund models, but then you're also going to have UMA and using, open architecture SMA platforms. On our platform today, broad strokes of the model portfolios, I think about 60% are actually advisor managed. And so that's when the advisors are building their own models. They're using ETFs and funds and individual securities and constructing their own models. And then the execution's all done through our platform. I think about 10 to 15% is at our own portfolio construction capabilities, so our own models. And then the remainder would be in third party marketplace. So I'm guessing it's, in the 25, 30% range. And so we think that that's about right for the RIA channel. Like I still believe that they're going to want to have their footprints or fingerprints over, the construction side more broadly, but I think that they're more open than ever to using a third party at this point.
The advisor-led models, do they tend to be for bigger clients of theirs, or versus small ones?
It is, for sure. You're going to see that with home offices. You're going to see it with advisors with some level of scale that they do have investment capabilities. But you'd be surprised. Like we see it even downstream with smaller advisors that may be using the capital markets assumptions of different asset managers and kind of putting together, best of breed, or at least their view of best of breed. But it definitely leans toward larger home office RAs.
How many searchable models are there for an advisor that wants to use a non-proprietary model?
Yeah, there's about 70 managers, and I think right now we're over 700 models. And so
wow,
you try to get to that sweet spot. We break it down into where there's a tier 1 and tier 2. And the tier 1 of our model providers is where we're actually doing rigorous due diligence. So it's almost like a select list where we're doing the screening. That makes up, I believe, about 30 or 40% of the marketplace. And then the rest of the marketplace either came on by relationships we've had with the asset managers, or we needed different, exposures, or in many times it's an advisor coming to us and saying, hey, can you add this manager? And so we're always balancing how wide can it get in terms of scope and capabilities without overwhelming the advisor, right? Because the second you have to sift through 70 managers and 700 models, there's more support needed. And so we think, we've curated it where we can be more helpful in tier 1, and tier 2 is kind of like going to the supermarket and you kind of DIY, get to decide what you want to use.
Yeah. Now I know Van Eck has a handful of models on your platform that are all proprietary, some which are open architecture in terms of allowing other sponsors' products in it. What tends to be the trend in your experience? Do advisors tend to like those that are multi-sponsored?
Yeah, I think that, again, specifically for RIAs, being open architecture is extremely important. And I think we've seen that, and it's played out. And BlackRock's probably been the best example of being open architecture. And I think that that's driven a lot of their success in model flows on the RIA channel. I think that, so there's multiple ways to kind of unpack that. So first, we believe open architecture is the best. I don't think advisors want to have, one proprietary manager having all of the underlying products as their own. So, when you think about broad asset allocation, I think we'd always lean toward open architecture. When you think about more like completion portfolios and you break up an asset allocation, domestic equities, international, and fixed income and alternatives, we see that that is actually where firms can create sleeves or modular completion portfolios that are fully proprietary. We've seen that have more success because then it gives the advisors the tools to build a, multi-asset class, multi-sleeve model portfolio and our UMA technology. And then they could use Van Eck in one asset class or, name the other asset manager in the next 2 or 3, 4 asset classes. And so you get, really broad exposure across asset classes and to different managers. They're kind of best in breed in different areas. And so I think either of those, whether it's open architecture across just broad asset allocation or giving the advisors the tools to put together more proprietary models, is where we've seen the most kind of throughput in our platform.
When you all onboard a new model, say from a Van Eck or another asset manager, what are some of the most important things that you look at?
It's a good question. You're saying in terms of just like the due diligence process?
Yeah. What, like if I'm an advisor and now I see a Van Eck model on there, what can I feel confident that GeoWealth has done in terms of due diligence, if any?
Yeah, I think that, well, again, there's multiple levels of due diligence. And so I think at like a high level, we're doing registration due diligence to see if the asset management firm's in good order, understanding the makeup of the investment committee and what their process is and what kind of continuity is. So I think that there's a broader qualitative screening we do. And then as it relates to like the tier one, where we're actually doing the deep due diligence, it'll be a combination of qualitative, and then we will do a quantitative overlay where we look at different factors across the different products, where we feel comfortable in terms of how, the manager constructs and implements and maintains portfolios. And so that really is done more in our tier one on the model marketplace. The tier two is, again, more qualitative and making sure that the reputation of the asset manager is intact, their registration's in a good place. We feel confident that they're acting as a fiduciary. And so it's in those scenarios, there's different flavors of how managers are basically selected to put on our platform and how they're utilized.
Now, when I've talked to you in the past, one thing I get pretty clearly is the way that you talk about the business. And so I think I know the answer to this, but do you think of GeoWealth as a tech firm or a financial firm?
So we're both, but I think the question you're asking is where we differentiate, and it's no doubt as a software company, right? And so as I think about TAMPs, there's always 3 components of TAMPs. There's the technology, there's the portfolio solutions or asset management investment solutions, and then the third part would be the outsourcing, so the middle and back office. So think recon, billing, trading, et cetera. And so I think it's really important as you look at those 3 components to understand like how you got in the business, why you're in the business, where you differentiate. And I think that for, different firms, they do it differently, right? There's firms that really specialize in outsourcing and they're using someone else's technology and then they overlay outsource provider. That's where they differentiate. We've certainly seen product TAMPs, which really are focused on the asset management portion of it. And as much as they're a TAMP, they're really an asset manager in their DNA. It's their solutions or a curated list where the value really is in the asset management. And then there's what I view as more like platform TAMPs or software TAMPs, where their DNA is in the technology and software and they own it all. And we definitely lean into that. And so our general view on this, long term, is that if you're not a software provider and you're not building your own tech stack from the bottom up, you will be consolidated in the asset management space, right? And if you just, as a TAMP, because if you look at the 2 biggest, it's Orion and Envestnet, and they've built everything. And obviously they've bought components, but primarily they're builders, right? They've built their software. If you look at the other, TAMPs in there that have scale, they are primarily asset managers. And so our view is that, you have broker dealers and RIAs. The asset management play is still primarily in the broker dealer channel. As you get to RIAs in a world where the differentiation is going to be in the, in the software, the user interfaces, access, flexibility, economics, like you have to own the software layer at some point. And I don't know if that's in the next 3 years, the next 5 years, or the next 10 years, but fees will continue to come down as an outsourced provider. And we believe that the differentiation really does lie in the software.
So yeah, when you talk about the technology, ultimately you're talking about the user experience, right? Just everything in terms of how they interact with the platform.
Yeah, and in the base, for a TAMP, the base is the portfolio management system. So think portfolio accounting, custodial connectivity, reporting, billing, all of the trading. So think order management system, rebalancer. And then the extension of that, that's kind of the core hub. But then you have all the services that live on top of it. So the marketplace for third-party managers, and then you get into kind of the advisor and client workflows. And so the more that that's comprehensive and integrated, the better experience for the advisor.
How are you guys thinking about AI these days? It's everywhere, it seems, or at least everybody's thinking about it.
Yeah, it's interesting from the standpoint of there's no doubt that it's changing the financial advisory, world. The pace at which it's going to happen in different components, I think, is what to look out for. Like, we've already started using it in some of like our back office operations. I think that, we haven't, our engineers from a coding standpoint aren't using it. They're certainly under evaluation. On the asset management side, I think that's a different animal, how you use AI to build models, and that's really not our core competency. And so for us, as we think about our strategy going forward, it's how do we make ourselves more efficient from an operational standpoint? But I think the other part of it is how do we start, building that into this, to the actual, like, the user experience to make advisors more efficient. And, we're early days on that. I think most are, but it's one of those things that firms have to commit to, because it's going to change it's going to change our ecosystem pretty quickly. And so it's something that's pretty top of mind for us.
A lot of firms are exploring that and looking at the best ways to apply it. I know we are in different ways.
The hardest part is, like, you're operating a business and we're already a later stage startup that's just, trying to disrupt the incumbents, and we're moving very quickly, scaling up fast from an organizational standpoint. We're already very wide in terms of our capabilities. It's one of those things that's like, it's a, priority. Like, how do you fit this into your priorities? What does that look like? And so, like any small company, it's, you try and focus on what you think adds the most value, both short and long term, and try to balance those.
Yeah, I'm trying to think back at something Jan Van Eyck said once, in terms of, I think he was just colloquially, but kind of meant it's like, we do like funds and projects. Internally, there's a lot of projects to get done, and I got to imagine you've probably got a lot of those things that you have to prioritize, and IT. And,
we do.
Yeah.
We were just doing some planning in terms of expanding the engineering team and what is our product. We're already on the 2025 product roadmap. And so it's frankly the hardest part of our job is where you put resources, and how do you think about ROI, and how do you balance the needs of, not just advisors, but prospects, but also internally, like our own scaling. Like, how do you think about scaling our own capabilities? And so it's always a balance in terms of, generally it's about 50% new features that are client, advisory facing, and 50% is actually just investing in our own scaling.
And so what, like, in terms of new hires, are you looking for more tech people, or are there different types of functions?
Yeah, we're at a point now where it's mostly engineers, right? I was just looking, I think we have about 50 in our product and engineering team. We're going to expand that probably by 15 or 20 people over the next 18 months. If we look more broadly across the rest of the business, we're pretty scaled up. Our investment solutions team is built. Our service teams are built. Operationally, I think we have 22 people. We feel like we're in a really good place there. Sales is in a good place. And so the corporate functions are all there. And so for us, it's all about what's the right sizing of the engineering team to tackle the product roadmap. And then what are the incremental kind of variable hires as we grow in operations and service to continue scaling. But we're not in a stage at this point where it's like, we're going to go from 120 people to 250 people in the next 2 years. It's more, how do we staff up to address our product roadmap? And then what are the incremental hires as we scale?
Maybe we can talk a little bit about the history of GeoWealth. I love the backstory, and hopefully you can tell me a little bit more about it in terms of just getting started, and you had no sales team. How did you get your first client on the platform?
It's a good question. Well, it's a long story. I'll give you the shortened version. So we started about 2010. We went to market actually by owning an RIA. And so we bought an RIA in early days. And so for the first 6 or 7 years, they were our only clients. So it did allow us to really focus, on the product while we had clients. We ended up divesting of them after our Series A round. I guess it was right before that in 2018. And that was really where we started commercializing the business. So it's only been 6 years where we've been, independently commercializing the business. But, like any startup, it's a lot of networking and hustle. I think I've had every job in the company from, back office doing, early days reconciliation and billing and trading, to helping build the product, to sales and relationship management. It just has kind of evolved. And so I think that what's unique about us, it's been very organic in terms of how we've built the business. And there's a couple things that have been very consistent. We've always been RA from day one. We've been always focused on the technology from day one. And it's allowed us to like kind of have blinders to a lot of the noise that exists in our, in our industry. It's been an interesting journey. I think, it's again, if I think about it in different sequences, kind of V1 GeoWealth was that RA that was a affiliate of ours, and it was really product build. I think V2 was how do we establish product market fit and scale up to some extent. And I think for today, we're really entering like V3, like, all right, what does the next 5 years look like? We've built the product, we've expanded the team, we've scaled up, we'll be profitable at the end of this year. And so, how do we think about like the next 5 years of growth and innovation?
Do you think that the trajectory has changed in any meaningful way in recent years, and due to what, or has it been level?
Yeah, I think we're definitely at an inflection point right now. We did our Series A round, I think, at the end of 18. We did a Series B round at the end of 21. And, sitting here today, we just completed a capital round that was led by BlackRock. And so it's put us in a position that, we feel like we have the right product mix and how we built the solution. We feel like we've done the right client segmentation in terms of like the advisor channel and the enterprise channel. And we've scaled all of that up, that it's a repeatable process at this point. And I think for the first time, we've done all of this kind of ourselves in terms of distribution and strategy. And I think we're entering a phase where we're bringing in partners to help us get to kind of that next stage. And so we're very excited about it. We did have a release a few weeks ago in terms of like new capabilities we're building that I think will be as differentiated as anything we've ever done. Historically, we've focused on really integrated ecosystem and how do you solve workflows in trading and model portfolios. And so it's been very much infrastructure and firm scalability. I think our next evolution is how do we provide like additional services on the margin that RIAs value. And so for us, we're seeing what's probably the most differentiated capability we have is our UMA or our sub-accounting infrastructure. And so our view is, historically model portfolios have been very much focused on the mass affluent segment. How can we use our technology to kind of go upstream and offer model portfolios to high net worth investors? And we think that's going to be really being agnostic to product type. And so where historically it's been mostly funds and ETFs and individual securities in model portfolios, we're going to start introducing alternatives in direct indexing and fixed income SMAs, where, traditionally have been in silos for that higher net worth advisor, and bringing that to an integrated team.
Oh, that's interesting. And you made me think of something back in the day when I lived in Chicago. I worked at a company called Ibbotson Associates, and there was a lot of research that they did on asset allocation with immediate annuities. I don't know if that's something you guys are looking at too, particularly for retirees and the distribution phase of life.
It's interesting. We stay out of what products to build. You're good at that. Our value in the ecosystem or the value chain is how do we make these products available in a turnkey way? Like at the end of the day, that's our value prop. And so I think it's being close to firms like yours and others and understanding what product types are being demanded by clients. And then how do you make it easier for the advisor to access them? And so we do have firms on our platform that are, that are in the insurance space, they're in the annuity space, that have used them to, as part of the proposal process, or have used them as part of, consolidated reporting at the household level. And so we're really product agnostic, and it's more, how do we meet advisors and clients where they are in terms of the products they want to use and make it as easy to access as possible.
Yeah. I imagine you need the right pipes or the technology to access those different structures or what have you.
Yeah, and it's interesting. It's not even the pipes as much as the infrastructure to sub-account away from the custodian. And so the more you could become the ledger of record for how the model's implemented, the more value you could provide, because then you can become product agnostic at the account level. And then you have to, figure out the piping of how do you do DI, how do you do alts, how do you do fixed income SMAs. And so it's all intertwined.
You guys acquired First Ascent earlier in the year, right? Does that add to your bespoke models?
We did. It was about, we're going out about 15 months now. And so, as we built out, our platform, it really had started to cater itself to RAs that were really $100 million up to multi-billion dollars. And we actually bumped into First Ascent quite a few times, and they had focused on the under $100 million state registered advisor. And it really was, the way it actually evolved is they were looking at using our platform and replatforming from the current technology to us. And what we realized as we got to know them is they would be a very complementary fit for us to serve, the emerging advisor. And so the acquisition was officially completed, I believe, at the end of the first quarter of 23. And so we have, for a lot of reasons, we didn't integrate them right away. We wanted to make sure there was continuity in their business. And so 2024 was the year that we integrated them. So as of today, that business is fully integrated inside of GeoWealth. Everyone's kind of one GeoWealth, and it's allowed us to think about segmentation of advisors and how to serve different advisor types, across size and complexity. So it's been a great addition to the team for us.
And I think you alluded to it a little bit earlier, but do you see more M&A happening in the space amongst TAMPs and in that business?
I do. M&A is an interesting thing. Specifically with First Ascent, we used it, or we viewed it as, it wasn't an asset purchase. It wasn't like we were trying to buy assets. We needed a capability that we didn't have. I think most of the M&A we see in this space is the really asset purchases. And so it's going to continue. I think that there's been a lot of it, but oftentimes what drives M&A is either a firm needs a capability. And I think the jury's out of like how wide you could get as a TAMP, where you start, there's diminishing returns on being too wide. But the other is, kind of stalled growth. And it's a way to continue to growing and scaling is through inorganic growth. So for us, we're from an organic growth story. Like, we just always feel like it's better to grow organically because you get to control, strategy, personnel, client base, and you don't inherit a lot of problems, right? And so I do think that M&A will continue in our space. There's not a lot left, frankly, in terms of how that all plays out, but I wouldn't expect us to be very active.
Yeah, the whole acquiring a firm and bringing a different culture into your culture is tough at times. I think we've done a couple, and
very true. And we saw it. We're seeing it firsthand with First Ascent, and they're great people, but it's change, right? And change can be hard for people, and whether it's the advisors, the clients themselves, or the staff, it takes resources and time to make sure that that's done correctly. And so again, as I think about our own journey, my view would be to grow organically, where it's and as long as we stay in our trajectory, I think that we can kind of control our own destiny there. But there's no doubt that there's going to continue to be consolidation, just more broadly in financial services.
Any other trends you're seeing in the RIA space, wealth management? What's top of mind in terms of biggest trends you're watching?
Yeah, I mean, and I think it's, repeating kind of what I said earlier. I think that you're seeing that advisors are more open to model portfolios. They're definitely more open to outsourcing if the model portfolios are unique and differentiated. If it's just a bunch of ETFs from different providers, I think they're less open-minded to that. I think that where we're going to see, I think in the next kind of 3 to 5 years, is that the higher net worth end investor is going to start using model portfolios and the different product types that they offer, because they really get the best of all worlds, right? They get differentiated products, they get cost efficiencies, and they get automation and we'll call it workflow efficiencies.
I guess with ETFs now, there's a whole host of different ETFs that do a lot of different things. Especially, I think one of the more popular trends has been options or derivative based stuff, and buffered products, things of that sort. So maybe there's some creative ways that creative model builders out there that could put something together. There
are. And it's a little plug for us. Like, we're always open-minded to creative, strategic thinkers that have a view that, there's trends that are impact advisors and their clients. Like, those are the partnerships we want. Like, we're not I think I mentioned, we're not the creative product types. We're the platform infrastructure play. And so we're constantly evaluating, having conversations like with Van Eck and firms that are doing unique things to make sure that what they're seeing in the marketplace and how they're connecting with advisors, we're making available.
I was just thinking, right before you, I just did a podcast with a fellow named Will Wilson, and he is somebody that had been an executive in the NFL, MLS, and sports, heavily involved in sports. He was an agent at one point. It was really interesting discussion where we were talking about the Olympics for a little bit too, as well as managing wealth for athletes. And I know you were an athlete. You're a basketball player.
Feels like a long time ago, Ed. I think I graduated college 17 years ago. I'm trying to do the math backwards. But yeah, look, it feels like a lifetime ago, but everything I do in my life, I believe, is kind of based in that foundation from, how I think about teams, how I approach my day to day in terms of challenging myself. And we've tried to make the culture of DNA, or in the DNA and culture of GeoWealth, very much that, right? And so we've hired athletes across the spectrum: tennis, basketball, hockey players. I think, everyone always jokes that we're probably the tallest company in the industry. I think we
So I have no shot of getting a job there. Okay.
but it's something that, I carry with me. And I think about, how I had different coaches, over my career, whether it was in college or Europe or high school, and how they managed and how they motivated and incentivized people. And so there's no scenario that I'd be where I am today without, that experience, and we value it. And so the intangibles that an athlete has that have been through being at a team, being in a locker room, being challenged, having to be resilient, realizing that the goal or mission of the company or team is bigger than that, like, it's very easy to integrate someone like that into our organization and culture. And so I don't think it's surprising that we continue to hire, former athletes.
Yeah, exactly. You read my mind. That's exactly where I was going, because we talked a little bit about how important the team is and team sports are to life, I think, in general.
It is. And I'll say, I think that's been one of my challenges as a leader. It's easy to manage a team of 10 or 12. Specifically, I was on a basketball team, so that's what I was used to. I think that it's been, eye-opening for me as the team's gotten, north of 100, is how do you continue to motivate? How do you make sure that your managers and your executives are, what we think about at the executive committee and how we think about planning and team and alignment, that trickles down to the rest of the company. And so, but it's a great challenge. We enjoy it. GeoWealth, I'm blessed. We really have the best team in the world, and we've had great continuity and really high character people. And so I don't take much credit for that. I think I kind of lucked into having some really good leaders around me, and we've kind of, built this thing very much team based.
I kind of asked you this question a little earlier. We talked about trends in the space. I'm going to ask a flavor of it, and this is an opportunity, if you want to take it, to just blurt out something totally different than what we've been talking about. But it's really kind of an opportunity for guests to surprise me with something. But don't feel any pressure. Just whatever comes to mind.
Yeah.
What's one long-term trend you see playing out over the next year or several years?
I wish I was creative enough to identify one thing and say this is going to be the major trend. I think we've touched on a few of them. I think AI is going to play a material role in how advisors service their clients. They're not going to replace advisors. I think that's one. I think two is that integrated technology for RIAs is going to become the play. And, we've had pure play software providers and TAMPs. I think that they're going to continue to blur, and they're going to become really just platform software companies that service really all RIAs. And I think the third is going to be, tailwinds behind outsourcing, especially if what's being, offered on the platform is differentiated from a product type. So those would be the three kind of key trends I think play out here over the next 3 to 4 years.
And as we close out, I'd like to do trend or fad. I'll try you out on 3 to 5 topics. Get your quick take. Trend or fad?
Yep.
Money market funds, trend or fad?
Ooh, somewhere in the middle. I mean, I think it depends on interest rates and the yields advisors get. I think that tools around making that more automated for how advisors use money market funds in their portfolios is really important. So I think that I wouldn't call it a fad. I think, but it's a trend, but it's going to be cyclical based on interest rates.
Tokenization, trend or fad?
Look, I've educated myself in crypto to the extent that I can. Our family office that still owns the majority of us is big believers in Bitcoin and how that's going to, the opportunities that it'll create for, more broadly and for money and financial services. As it gets to tokenization, I would say it's more short-term fad, but I think that there's real longer-term trends where it becomes applicable. I just don't know how quickly it'll happen.
India, trend or fad?
Oh gosh, that's a tough one. I'm gonna put that back to you, because am I allowed to do this? I never said, is it a trend? What do you think, trend or fad?
Oh, we think it's a big trend, and it's
okay.
Yeah, it's a seeded question to see what you'd actually say, and hopefully you would say India.
No, I mean, look, it's going to be the largest economy in the world at some point, and so it's something you definitely have to pay attention to. I think sitting in our seat, U.S. based company focused on the U.S. market, certainly there's global investment exposure, but you can only focus on so many areas, and so it's not one that I think I have a real distinct opinion of.
Okay, and since you're a sports guy, I'll ask you another one.
This is where I might be more comfortable.
Pickleball, trend or fad?
Oh gosh, it's not a fad. It's here for the long term. But I'm a tennis guy. So in my last 6 or 7 years, I really got into tennis. I love it. Follow the tours and play when I can. And so look, there's room for both of them. I think there's been an area where it's like, is it tennis or pickleball or paddle or whatever it is? I think the more people are out and active and healthy lifestyles, I'm supportive of. But I would like to see younger people play more tennis until they can't. And I think pickleball is fun, but it's kind of like golf. People ask me if I golf. I'm like, I like to golf after I do my activity or work out. I don't consider it like an activity. And I feel the same about pickleball.
Yeah, people ask me if I golf. I tell them it's a matter of opinion.
I haven't played yet this year, but I do. I enjoy it.
Well, this is cool. This is great. Colin, what's the best way for people to learn more about you, your business?
Yep, GeoWealth.com. Our website, there's plenty of different forms you could fill out to learn more, get demos. Obviously, enjoy being on it. We've been partners and fans of VanEck forever. And so we'd love to work together, more closely in the future.
Awesome. And thank you. Really appreciate the time and the insights.
Sounds great, Ed. Thank you. Appreciate it.
And thank you for tuning in to another episode of Trends with Benefits.